Rob's Child, nothing I say is investment advice. Welcome back to the series where we cover every chapter of Benjamin Graham's The Intelligent Investor. This edition we are going over is the 1972 edition, following the 49 edition and the 65 edition. The intention of this series is to function as a review of the materials of the chapter, see how some of the lessons may be applicable to today in today's economy and today's market as of June 2024, as well as provide you with some information from my perspective from how it compares to security analysis from 1940. This is like the unabridged version of this book, and it's obviously older but considered to be the Bible of investing by a lot of investors. One of my goals is to try to explain things that might be a little hard to understand, especially for people that are reading this book first. And I encourage the viewers to read the chapter before watching the video. This should serve as a review and a connecting, just to get the lessons deeper and to be able to retain it and use the information more. There is a link in the description of this video, a direct link PDF file of this edition of this book that we're reviewing. So today's chapter is Chapter 6, Portfolio Policy for the Enterprising Investor, Negative Approach. And it's mostly about eliminating things that maybe people should be at least wary of, if not discount them from the possibility of buying them at all. I found this chapter to be very much in line with his book in 1940, The Security Analysis. And so we begin. So we start with talking about the enterprising investor, he's trying to have there be like defensive investor versus enterprising investor. What's different, what's the same? And we start by stating simply that the enterprising investor should actually be the same as the defensive investor in some ways. Namely, this is a quote, a division of his funds between high-grade bonds and high-grade common stocks bought at reasonable prices, and have good reason for departure from this as their baseline. So even if you don't consider yourself to be a defensive investor, he says, this should really be the basis of your portfolio, what he goes over in the defensive investor stuff. High-grade common stocks, high-grade bonds bought at reasonable prices, reasonable enough. So then he has something very interesting here. He says, use not just competence and equipment, but also interests and preferences. And again, my favorite thing with this is how it connects with psychology, because at the end of the day, you are a person. When you're deciding like what securities to buy, you are a person and you have emotions, and there are certain things you like, there's certain things you feel like you have more knowledge about. It's interesting today in 2024, especially on YouTube, I find some people that are, all they care about is the gold market, the silver market. All they care about is the uranium market. You have all different types of investors invested in different, with strong interest in different things. One of my deepest interests is actually is bonds, treasury bonds, and just the bond market, just bonds in general, and trying to figure out how to get an edge basically through bonds. I just like them, but I like bonds in general just because, it's just more secure. Like, it's safer. Bonds are safer than stocks, generally speaking. But I digress. All right, so most useful approach is a negative approach. So not what am I looking for, but what should I eliminate from my choices. And he says avoid preferred shares. He hates preferred shares. Yeah, every book he writes, he his emotions really open up about how much he doesn't like them. But he says avoid preferred shares and high yield corporate unless they're at a bargain price. Be wary of new issues, convertibles, stocks with limited earnings growth time. So just, noting on that, when we get through the chapter, he basically, spoiler alert, um, says that, basically don't buy new issues, but it's a little more involved than that. If a company's been around for a long time and has earnings, that counts. Before it became public, before it was sold to the public in any way. But we'll get through the points. Anyway, next part, he mentions that time. He mentions in that time, as of 1972, high yield bonds were forced to be sold as convertibles. So, in other words, and that's convertibles are great. You get a bond, and then it's also like, and you can trade it in for this many stocks someday. So if the stock price balloons, the value of your bond balloons with the stock, and so you have that safety. That it's a really good feature of corporate bonds if you get into them. But so high yield straight bonds were selling at a bargain. So in this period, because so many people were selling convertibles, the regular straight bonds would have to be sold at even a lower price, assuming the credit rating goes up and interest rates go down, for the straight high yield bonds selling at a great discount. He mentions, however, these were competing with older, higher grade issues also selling at like 50% off, so there's not really a need for the convertibles or, newer straight bonds, I believe, high yield straight bonds. Then we have a point where he mentions, just like from security analysis, that it is unwise to get a high yield bond without good safety. The high yield basically isn't worth it, is what it comes down to. So when a new company comes out and says, hey, we're selling these bonds with a 10% coupon, way above what you can get, or even higher these days with treasuries yielding 5%, means I imagine you might get some new issues, over 10% in this time. But he says, the high yield just isn't worth it. And we go through why. Big point here, 5-star point. Bad times or bad markets make high yields get really cheap. And that's when they're worth buying. And I'm going to show how that can apply to today and how you can easily take advantage of that yourself, and it's something I plan on doing if we get into a major market correction. And then I have 7 stars here, example of divergence between 10 railroad companies. And he says, okay, so out of these 10 railroad companies, the earnings seemed to be fine, but the entire market was selling off, making high yield bonds highly discounted. And then not only that, the price decline of the bonds was higher than the stock decline. And this is very interesting and very good to know about. When you have a stock market collapse, some people think, oh, it's time to buy all the stocks. Well, if you had done that at the bottom of the Great Depression after everything fell off of a cliff, you'd be waiting quite a while for your stocks to appreciate in value, a long time, because stocks are they're more heavily weighted in their price as to how popular they are. And when they're very unpopular, they can stay unpopular for a long time. Especially considering many stocks don't have any dividend yield, or it's lower, the yield's lower than what you can get in bonds. And so, you can have long periods where stocks drop and then stay low for a long time. That hasn't happened in recent history, but it can happen. And if you have this is the thing that most people just isn't a part of their knowledge. When the stock market really collapsed, the corporate bonds also drop in price, but the difference is that when a stock drops in price, you never know how long it's going to be low, or if it'll come up, or if it'll ever go up again. Whereas when you're buying a bond at a severe discount, the coupon rate, let's say you have bonds go from being worth $100, let's say, with a 10% coupon. So you're getting 10% every year. Well, what happens if it drops to the price of like 50? Well, then that's a 20% return. That means over 5 years, you've already made up, no, it's less than that. 2, 4, 6. In 3 years, you would get cash that would pay off the price of those bonds. You're paying $50 for a bond, so 50% discount on the bond, and therefore it has a 20% dividend. So 2, 4, 6. No, it's 5 years. Sorry, my math. 8, 10. So over 5 years, the bond has already paid for itself. You've already doubled your money, and you're not even turning the bond. You're not even selling the bond. The bond itself has value, and so you're tripling your investment over 5 years with, very limited risk, assuming that this high yield corporate bond in the first place wasn't going to go out of business. But there's more severe cases of that, where it goes from $100 down to like $25, or and if that's the case, it pays itself off in almost 2 years, and the market wakes up to that pretty quick when things turn around, and then the value of the bonds balloon up, and that's the time to sell. The biggest advantages you can take in a market decline are not in stocks; they're in bonds, especially high yield bonds. I'll be showing a chart momentarily regarding this as well. Anyway, to continue on, regarding these 10 railroad companies, he mentions that the original buyers of the bonds were basically just dumb. They were higher risk, and there's no chance of capital appreciation from the full price of a bond, and it's all just for a slightly higher original yield. So when you're looking at bonds, most people these days don't even know that bonds exist. I mean, your typical investor these days, it's Nvidia stock to the moon. What could possibly go wrong? Anyway, I digress. We have another 7-star point. I think this chapter is very important. This is another thing I hope people get from this video, is to realize the importance of these chapters, because I hear people sometimes reference this book, The Intelligent Investor, in regard, they get like a few things out of it, like, no, this is good stuff. You don't know how good it is until you get through this beast, and you see hundreds and hundreds of examples and illustrations of how it all works. This is the tip of the iceberg, this book, The Intelligent Investor. And so my 7-star main takeaway from this little section, same as in security analysis: only buy high yield corporate at a discount and realize the greater potential for capital appreciation, basically from it going from a really too low price to a normal price, and safety over stocks in a down market. So again, if a company has stocks and high yield bonds, and the bonds, especially like he says here, shrink in price more than the stocks, that's crazy. The value of the bond clearly is, it's much safer than the stock, number one, just flat out. That's just not even a question. But then the potential appreciation back to its previous price, I mean, it seems like that was a really great opportunity in that time, and I think that those times come still today, periodically. And I think there's one coming myself soon, but I won't get into that here. So then we have notes. He notes that nearly all high-yield preferred shares and bonds suffer severe sinking spells in bad markets. So the point being here is just be patient for these things. Yeah, it pays 10% now, but when the market crashes and it pays 20%, 25%, 30, 40%, that's the time to load up. And so, and he says a large amount of them recover. So not all of them recover. And this is the part where I'm going to cover HYT and note how it often dips and never rips. So here's a chart of HYT. This is a fund of high yield corporate bonds and preferred shares. I am pretty sure in his time, Benjamin Graham, this didn't exist. If it did exist, I'm quite sure he would consider this to be one of the coolest vehicles for investing on the planet, and I certainly feel that way about this fund. If something did exist similar in his time, maybe there was a mutual fund or something, but this is highly liquid ETF. It trades just like owning just like owning a share of a stock. It's a collection of high yield corporate bonds. Currently, this fund, by the way, every year that you own it, right now at its current price of $9.65, I believe the yield on it is something around 9%. So you're getting you're getting $1 every year for $9. And so over 10 years it pays itself off. You already automatically double your money holding money in here in 10 years. Now what Graham is saying about the way this works, he's saying, when times are good and everybody's happy, high yield, everybody's selling these high yield corporate bonds. People are buying these things up here when prices are high, just because they want to get that higher yield. And that's great, but this thing always dips majorly in bear markets, and it always will recover. Now at the bottom here, some of the securities that this fund holds are going to go bankrupt. They're going to lose all of their value, and so that's why it can and will drop this low, because it will lose some along the way, but a large amount of them, in his words, recover. And in this case, if you just look at the great financial crisis, we were in a range of this being valued between $15 and $12. We dropped all the way down to a depth of $4.50, and the smart, intelligent investors were loading up on this fund, I guarantee you, when we had the big collapse in 2007, 2008. And this is where I plan to be if we get into another collapse. I'm not looking for stocks. If we get into a major correction, I will be in this specific fund. And as you can see, how long did it take to recover? No time at all. And if you compare this to the stock market recovering, the stock market also recovered, but not this much, and not with securities that have much lower risk. Again, these are bonds. These are guaranteed payments. The companies issuing these have to pay their coupons. Although, if they can't, they have to sell their store. They have to sell everything to give you your return on these bonds. So they're highly valuable, and when they get depressed, like $4.50, and you buy it, and not much time later, it almost triples. We're at $12, and we get up to $13, tripling your money with like guaranteed securities. This is just like a no-brainer. And then we have like the COVID dip. If you were able to, if I knew what I know now, and during the COVID dip, I certainly would have loaded up on this then. And we went from $6 a share to $12 a share. So doubling your money when it recovered, And I mean, since then, this has lost value, partly because rates have gone up. So when Treasury rates go up, this does have a little bit of interest rate sensitivity. And on the flip side, when rates go down, the value of this can float up, relatively speaking. But again, you don't want to be buying high yield corporate anything unless you're in a situation where things are really depressed, a stock market bottom, something like that. It's not worth a little bit of extra yield considering the amount of risk that you're taking, that this thing can dip. I mean, that's what this chapter is really all about. And as an investor in 2024, this is how you do it. This fund, there's another one, HYG. I think this one has more beta though, so it has a little bit more risky stuff in it. But as you can see, even from the great financial crisis, it recovered marvelously. So, one other note about that is, again, you could have stocks, if stocks didn't recover from 2007 moving forward, you still would have been much better off because, again, the payments coming in from the fund, along with the capital appreciation, it's just a no-brainer in a down market. I forgot to mention one more point. So again, the important part about this is one of the reasons you don't buy at a top is because it also never rips. It often dips, and it never rips. You'll never see this thing suddenly skyrocket to $20 a share. I mean, if you do, then people are being really dumb because they're taking on much higher risk, and then comparing it, the credit spread, so the yield you can get here versus the treasury goes smaller and smaller, and so if it was priced up here, it would only have like 1% advantage of yield, and that would be really dumb to buy it in a situation like that. But the main point is that it always dips and then it bounces up. It dips down. It never rips up higher and higher. It just dips. So buy on the dip, wait for it to recover, sell it when other people are desperate to try to get higher yield, and that's how you do it. Next in this chapter, we have a part mentioning how there were some long overdue cumulative PDFs recovering. So it's another PFDs, preferred shares. So, cumulative preferred shares, that's a really good feature. He doesn't like preferred shares in general, but if you add cumulative to it, before they're allowed to pay anything to the regular stockholders, they owe you your coupon for the past however many years. And if you bought it at a discount, that would have been an incredible, nice situation for investors involved with that. So, so the point being here is that they hadn't paid an example of preferred shares, and the price was highly depressed, and then it recovered, and then you get all of the back payments. It's like that's an incredible find to find if you can find something that can do that. All right, and then we move on. He admits that high yield can be okay for investment at par. So, buying where I said don't buy on that HYT chart if you can stomach the volatility. So, it's true. If you want to get a 9% cash return on something, HYT is great. It has 9% now, and if it drops it by 50%, that's 18% a year. But the whole point is, most people can't diversify. Oh, well, before we move on to that point, so you can only buy it when it's not at a severe discount if you can handle the fact that it's going to dip. It's gonna dip. Some of the things are going to go out of business. So this is where today it doesn't matter so much. So he says, however, most people can't diversify enough for safety, and that's why, why would you bother anyway? Because they become so discounted frequently. And so, again, today you can diversify enough for safety. It's called an ETF. It's called getting a fund that holds hundreds of different companies' securities, and you own all of them just with one ticker symbol. Today they make it too easy for us today, to be honest. If Graham was alive today, he'd just be amazed at how easy things have become. So but anyway, I just wanted to note with all of this section, so regarding this, he is saying do time the market, especially for high yield corporate. This is an easy way to take great advantage of discounted securities in markets. Moving on, we have a section on foreign government bonds. He goes through a number of catastrophic examples, blowups in Cuba, the Congo, Greece, Poland, Czechoslovakia, and how that one, the last one, was a really crazy roller coaster going up and down, up and down. So he mentions, I find this fascinating. Even in 1972, it was considered to be moral for some investors to lend abroad as Americans, having the central reserve currency, like, yeah, we won the war, we're the king of the world, world reserve currency it's the dollar, and so, we gotta lend our money. And it's like, that was going on. It's like a moral obligation to, lend your money to foreign governments for bonds. But he concludes for this section that no, it's just generally a bad idea. So yeah, not much to get out of that other than, don't buy foreign government bonds. I think Graham would be, he probably talks about this later in the book. This is different between companies and governments. So I think he would be happier to lend money to a corporation in another country. He even in security analysis talks about how political risk shouldn't be too great of a concern because, when you own stock of a company, you own the company. And so, no matter what happens to the currency or whatever, it's still making things and selling them. And, it's not a bad way to invest. But, foreign government bonds, you're depending on the stability of the actual government. And, so anyway, moving on. Just no. Next section is about new issues generally. So in other words, like IPOs, like Reddit just had an IPO. Hey, they're selling bonds like, here, give us your money. We're going to give you coupons on it. Here, give us your money. We're going to give you stock, so you're an owner of the company now. And so there's a section on new issues. That's what those are. So first thing is buyer beware, especially because of the salesman effect. People get all excited. Oh, you see it on the news. Oh, Reddit's selling stock now, and then everybody buys it. He says, buyer beware, especially in good times. If the stock market's at an all-time high, like it is today, oh, yeah, but Reddit stock, I want to own Reddit. That sounds like a great idea. Graham would highly advise against that. So note, selling more shares at peak. So companies tend to do this, that when stocks are up and high and everybody's paying, everybody's trying to get the next hot thing, and like, oh, that thing, everything's already expensive, so I don't want that, so I'll get this. Yeah, not a good idea. When things go down, your thing that you bought is probably going to go down way more than the things that are all that might be overvalued. It's not a good idea to be looking at new hot companies when the markets are on fire. Really bad idea, in fact. And he goes through a bunch of reasons and how that works and why. So it's worse with higher risk securities like high yield and small cap. Not as bad of a situation for high grade bonds. If you're, buying high grade bonds just to have the small coupon and there's not really any risk, that you don't have to worry so much. But it's more regarding higher risk stuff, small cap, high yield. And then there's an extreme example in the footnote about an IPO boom in 1825, where everyone, basically it would be the equivalent of today, if you had to go somewhere to buy Reddit stock and there was like people crowding all around the place that sells the stock, and things got actually violent. People got stampeded, and then a few years later, after buying these hot new issues that everybody wanted, they lost an incredible amount of value. And I even said in the book that some investors hired henchmen, they said, to like get in on some of these IPOs that they were so excited about, and it turned into a disaster for all of them. So fair warning there. And what's so funny is that how that relates to today, and we're doing the same thing today. All these meme stocks, it's like ridiculous. But anyway, new common stock offerings mentions that this is unchanged. He didn't change his view since 1959. We mentioned that private to public gives this is from the 59, that nothing changed. So mentions that private to public gives owners a chance to sell some of their ownership, take off risk. They take advantage of dumb money buying at market peaks. So again, when the whole market's way up, that's when smart people in businesses that had, people are paying like crazy amounts for ownership of things, and it's clearly, even if it's clearly not worth that much, so why not sell some of it? And that's how it works. That's what's going on here. It's pretty not that hard to understand, really. Like say you own a restaurant yourself, and restaurants are selling like 10 times as much as they did last year. It's like, well, I'll sell some of my restaurant. I'll sell the whole thing. Heck, why not? Anyway, moving on. Bull market, he says, in general, bull markets dull the public's critique. So that's the thing. When things are really down, it's the opposite. But in the middle of bull markets, he says that buyers of new issues tend to do well. And then as the cycle continues, what happens is the market keeps going up, the quality of new issues starts going down, the prices go higher, and you get more and more IPOs. So that was interesting. I'm not sure we've seen that exactly today. Maybe we have. I guess one thing to research would be looking up just number of IPOs year to year. So you know what? Let's just do it. That was easy. We gotta love Google. It takes 2 seconds to find this information. Number of IPOs by year. This is from stockanalysis.com. Wow, I'm a little blown away. Look, this chart goes back to 2000. If you can't see, maybe I can zoom in a little bit. We can see the chart better. We had 400 IPOs in 2000, right before the dot-com bust. Wow. And then we, of course, dropped to 141, 183. Let's see here, and then we're in the 300s, 200s up until 2007, and then we have a massive drop in IPOs. No one wants to sell their businesses and go public when everything's too cheap. Why would they sell it? Doesn't make any sense. But when things are going good, 2014, if the stock market goes up higher than it should, things are getting overvalued, why not sell stuff? And then look at this. This is incredible. 2021, over 1,000 IPOs. That's unprecedented. This is when not only that, 2020, we had 480 IPOs, and then 2021, 1,035 IPOs. And so during that year, people buying new companies, new stock, the newest, hottest thing. I mean, the value was on fire, and people just, selling like crazy. Very interesting. And then over the past years since then, they've actually dropped below normal. It almost looks like we're in a recession or something's going wrong. Anyway, back to the chapter. I think you get the point of how this sort of works. All right, so I have 1 star point here for it's fairly dependable the end to bull markets is when new small companies have offerings equal or higher than mid caps. So if you can compare, basically, like, I guess the easiest way to do that would be looking at the market cap of like companies that are making only a little bit of money versus a mid cap. They're making a little more money, but the value of the small caps is like equal to the mid caps because people are like buying them up, and that's the end of the bull market. So that's pretty interesting. Anyway, I think again the main point here is that it always ends in disaster with all these IPOs and secure high yield corporate new issues, not selling at any discount, because they always eventually fall to below what's even a good price, and that's really when to buy. And I noted here that it reminds me of that chart of the bull bear cycle phases. If you haven't seen it, it's right here. So basically, it just reminds me of when things dip, they go below what's even normal. So you have this being the mean, the average. So over time, it generally goes up, but you often have these sort of bubble valuations where you get media attention, enthusiasm, greed, delusion, new paradigm. Oh, and that's my favorite. And you literally hear people saying that still today, that we're in different times. And then we have a dip, the denial, bull trap. All right, we're returning to normal, and then we eventually go into fear, capitulation, and then that really drives things down into despair, where things get actually way below the price that they really should be, and before returning to normal price again. All right, and so moving on, basically resist the hype and salesmen of new issues. Especially, they're not at a discount. Just wait for them to be on discount, then buy them. That's the whole point here. They might become extremely cheap and therefore attractive in the near future. And then he mentions in this 72 edition from the 65 edition that he notes that they had never had more new issues sold than before the 1960s. I guess this was from 49 to 59, probably that period is what he's talking about. And then he says in 1960 and 62 there was a disaster and extreme price collapse of those said new issues. And then we've finished the chapter citing two examples of IPOs, and then the stock price doubling. Everybody's getting all excited about it, and so it doubles and then goes down basically to pennies. And that's all we have for today's episode, Chapter 6, Portfolio Policy for the Enterprising Investor, the Negative Approach. I hope this video has been helpful for you. Thank you for watching, and now it's time for you to read Chapter 7, and see you next time for the next episode, the next chapter. Rob's Child.